The IRS is now going to have another $80 billion over the next 10 years to oversee our tax policy and compliance. And Larry Summers thinks that alone could raise almost $1 trillion. Whereas I think in this package, they're assuming it's more like the $200 to $300 billion range over 10 years. Well, if nothing else, that might increase compliance from a tax policy point of view. So now on to, before we leave fiscal policy, one thing to note importantly, I've mentioned it a few months in a row now, is that federal outlays are falling. They're down 14%.
The jobs data proves it. We've got this booming, red-hot economy with a smoking hot labor market. We're creating all these jobs. So we can't possibly be in recession with so much job creation. In fact, a lot of the investment banks now are thinking the Fed's going to raise by 75 basis points in September, not 50, given the strength in the labor market. But if you actually look beneath the surface of these numbers, and you don't have to go that deep, the jobs report tells a completely different story. I don't think what we're looking at evidences strength in the labor market. I think it evidences weakness, particularly weakness in the economy, not necessarily the labor market, although the labor market itself is not strong just because jobs are being created. Wages are rising faster than people thought. Now, again, bear in mind, the 5.2% increase in year-over-year average hourly earnings pales in comparison to the 9.1% increase in the CPI. So that means that real average hourly earnings are down 4%. And again, what I've been saying about the labor market is when you have a labor market where real wages are falling, especially as much as 4%, that does not indicate a strong labor market. I don't care about how many jobs are being created. What I'm looking at is, are the workers getting pay raises or are they suffering pay cuts? Because in a strong labor market, you get a raise. The worker can go to the employer and demand a raise. And in a strong labor market, you'll get a raise because you can quit and you can get another job.
And if you look at the money numbers sequentially, what you will find is they have flattened out for the last few months. Now, if that were to be sustained, that trend or lack of a trend, then we would be working down to 0% money growth over the next six months or so, and possibly negative. Some people do believe the money growth rate will go negative. And if it does, I believe that will be the first time since the Great Depression in the 30s. And of course, that would also represent a tremendous drag on economic activity. So we've got both sides of policy, fiscal and monetary policy, really moving in a pro-cyclical manner. What that means is typically in a recession, they'd be counter-cyclical. You'd be stimulating. They're doing the opposite this time around. And I think that's why a lot of people are going to be surprised at this idea that we actually are in a recession.
Also, the unemployment rate, it ticked down from 3.6% in the prior month. It was supposed to remain steady at 3.6. Instead, we went down to 3.5, and that matches the 50-year low in the official unemployment rate that we had just before the pandemic, maybe in February of 2020. Looking at the rest of the report, private sector payrolls, they shot up by 471,000. That was more than double what was estimated at 220,000. And again, the prior month's number was also revised up from 381,000 to 404,000. Even manufacturing came out double what was estimated, came out at 30,000.
Is that federal outlays are falling. They're down 14%. Now, the government sector is almost 20% of GDP. So that's a big hit to a big slice of the economy. Now, it's understandable because it's really just the runoff after the stimulus payments last year. But the important thing to note is those who were expecting inflation to stay in the system, or who are, much like it did in the 70s, they're losing one argument, because back in the 70s, we never saw federal outlays decline.
The point of this report is to compare gold with the commodities, because so many people are making the statement and assumption right now that, gee, gold's not doing well because we've got this commodity price inflation, gold's not going up. Well, the correlation between gold and commodities specifically is not good. During that period from 1999, gold made a low in the $250 area, okay? It surged up to 850, then had a pullback, and then went all the way up to 1900. It doesn't quite show it there because the monthly close is above 1800, but it did get to 1900. Okay. Now look at the same time from 1999 to 2008, commodities were going up too. So it seems to be coincident. But look what happened in 2008. Commodities collapsed along with stocks in 2009. Look what gold did during that period. There was a little dip there. We went from high monthly close in the 900s to a low monthly close about 700, and then you blew the lid off gold. Commodities didn't explode then. They bounced halfway back to the high, while gold doubled. The stock market went up sevenfold over a dozen years as measured by the S&P, 16-fold as measured by the NASDAQ 100. It's the biggest stock market bubble in U.S. history. So the inflation that we had between 2009 and 2021, and we had a lot of it, and we know all the excuses and names they attached to it, went into the stock market. Now, major asset managers around the world, and there's a lot of them who aren't gold bugs, but who see reality, have made statements to the effect like Ray Dalio did about 6-9 months ago. He says, listen, quit looking at the price of your stock, implicitly stating that it's not so meaningful. Instead, look at the underlying degradation in the value of your money. Okay. In other words, the central banks are destroying your money unit, and it's reflecting in your stocks with higher prices, but it doesn't mean much because your money unit's degrading. So that's an inherent bias favoring gold. And asset managers like him, and I can't specifically talk about their portfolios because I don't know it, and who don't buy into the argument that the Fed is making that we're going to tighten and tighten, they know better. They know what's going on. They can see the severe drop that we've had so far this year, not just in the stock category, but in things like high yield corporate debt, municipal bonds, and treasury bonds. And what does it mean? It means, well, that can't keep going on because those assets, if they continue to decline, and we argue they will, especially the stock market, the Fed will have to come to their defense again. Meaning there's a point here probably very soon where they're going to have to stop and reverse. And we're not the only ones saying that. We know what the Fed is created for. It's to ultimately be the backer of government debt, because the taxes don't pay for government budget, never have. And they're going to need it because the purchasers of U.S. Treasury bonds and municipal bonds and corporate bonds are going to be shaken, or are already being shaken. So the Fed is going to have to come to the rescue yet again. And frankly, they're repositioning to a tight policy, which, by the way, the ECB has waffled around, and the Bank of Japan has not proceeded in that direction.